Your tax return is the secret. It is the key to your efficiencies. Welcome to the Retire on Time Q&A podcast. This show is all about answering your retirement questions. Say goodbye to that oversimplified advice you've heard hundreds of times. This show is all about getting into the nitty-gritty. We want to give you context and clarity. Now, that said, remember, it's just a show, not financial advice. Keep doing research. As always, text your questions to 913-363-1234, and we will feature them on the show. David, what do we got today?
Hey, Mike, I just got my tax return done. What should I be looking for?
How to read it.
Yeah.
So I have a whole section in my workbook, the official Retire on Time workbook,
Okay, all right.
that walks you through step by step what every line in your 1040 means.
Oh,
Now, if you've got a business, if you've got real estate, Schedule E, we'll talk about that. So if I forget, bring that up.
okay.
But the main things to look at are really, in my mind, it's 2 through 7. So first off, what is 2A? Tax exempt interest. No one really cared about that until recently. Your modified adjusted gross income is going to qualify you or disqualify you with certain things. Also, modified adjusted gross income affects your IRMA. But that's your tax exempt, your municipal bonds, for example. Okay. So you want to be aware of that. Then you've got that's 2A. 2B is taxable interest. Excuse me. Taxable interest, that's an important one to keep tabs of. If you keep too much money in your high yield savings account, that can push you over the line and create some tax issues. So you might think, oh, high yield savings, how bad is that? Well, if it's 3 or 4% of $1 million, that's going to show up. And if that shows up, it could push you over an IRMA line, or it could disqualify you from a part of the One Big Beautiful Bill deductions or something of the matter.
Okay.
But the bigger ones, I think, are 3A and 3B. So 3A are qualified dividends. If you're buying a stock or holding it for a long enough period of time, your dividend can be taxed as long-term capital gains. That's important to know. That's more tax efficient. If you've got 3B is whatever your qualified dividends are, which are taxed as ordinary income, plus your qualified dividends. So you have to kind of back out what the actual number is. But when I see those numbers are really high, I always ask the question, what are you doing with your dividends? If you're spending them, it might not be an issue. If you're reinvesting them, you are creating a tax bubble.
Oh,
And as you reinvest them, it gets bigger and bigger and bigger. That's a problem.
right.
It might be a problem. Maybe you're not. Maybe you're okay with paying more in taxes as your growth. But I mean, would you be upset if you bought, let's say, I don't know, Apple stock, and you had to pay taxes on every year that it grew slightly? That's kind of what's happening. Dividend stocks are growing through the dividend, not necessarily through the price appreciation or the growth of the price. So you just gave yourself an unnecessary tax headwind. If you want, you could sell it and move it over to your IRA and keep the stock just in a different part of your portfolio like that. That's fine. But you want to be tax efficient. So 3A and 3B are often lines in the tax 1040, the tax return, that people miss or don't know what to do about it. Those little adjustments can make big differences on your tax returns. And I'll just skip down to line 7. That's I think the other big one here.
All right.
I mean, if we had a 1040 here, we could probably do a lot more, but it's a podcast.
Yeah.
So in line 7, those are your capital gains being realized. If your brokerage account is actively managed, you have to ask yourself, are the trades worth the taxes you're paying? And what's the net of tax return, net of tax and net of fees? And what other consequences are you paying? See, people just look at, oh, well, here's the growth of the trades, and they forget the tax bill they have to pay. What's the growth of the trades plus the tax bill plus the fees? Because if someone's actively trading, that's fine that people charge fees, but what are the fees? Okay. And then are these trades triggering issues with your healthcare, with IRMA, for example? So I mean, what's an extra $400 a month because you wanted an actively managed asset? That's a lot of money.
Yeah.
And then $400 a month in additional healthcare costs, plus the taxes that you paid, plus the portfolio and the fees associated with it, when you could reposition it potentially into let's say it's very boring ETFs, You don't really rebalance it once, maybe every 3 years or so. It's long term. Maybe you're going with the big buyback ETFs, like is it KPD? I forget the ETF. Uh, Invesco has one where it's large companies that typically buy back their shares
Okay.
instead of paying out dividends. That's more tax efficient.
Ah,
Maybe it's Berkshire Hathaway. They don't pay a dividend.
yeah.
They probably never will. So that's a way you can restructure for long-term growth. You can sell as needed under your or under your terms for long-term capital gains, but you're just being more tax efficient along the way. And the 1040 is the scorecard. Absolutely important to look at every single year. And I'll even add this. If if there are capital gains issues or it's just a part of your life, that's where you go into direct indexing. And people have never heard about this. Many people have never heard about this.
Okay.
So
Tell us.
instead
Yeah.
of buying the S&P 500, SPYVOO, whatever,
Uh-huh.
you can hire a company or do it yourself if you really want to put in the time. It's a lot of work. And you buy, let's say you buy 200 of the S&P 500's positions,
Okay.
but you bought every one of those positions and you've had to allocate it to mimic what the S&P is expected to do. But instead, the division is things would be things like, um, some of these people are going to be upset with me comparing, but Pepsi and Coke,
Uh-huh.
Apple and Microsoft,
Sure.
right?
Yeah.
you know, but
Fighting words.
yeah, we
Mhm.
both have iPhones. It's okay.
Yeah.
But the idea is they're not going to follow exactly the same. But let's say that the beverage industry goes down and you have Coca-Cola. You didn't buy Pepsi, you bought Coca-Cola. And Coca-Cola goes down and you sell it at a loss and then you buy Pepsi and then Pepsi grows, increases. You're directly indexed. So you've kind of bought roughly what the S&P is.
Mm.
You're trying to track the S&P, but you're harvesting losses along the way. It's very difficult to do, but this is how you get out of highly appreciated stock, or you just lower your overall tax bill. And in the first year, you might have, and this is very general, kind of setting expectations. It could be any given way. This can vary, but maybe you got if you put in, 250, 500,000 million dollars in there, 10% of your assets that you put in there maybe was able to generate some losses that offset other things.
Mm.
And you might bank that. You might use it that year because if you harvest losses and you don't have and you don't offset enough gains, you can just have it for the next year. It rolls over. Okay.
Okay.
First year might be 10%, maybe 8% the next year, maybe 6% the next 5% after that. Like at some point, everything has grown enough that there's really nothing left to harvest.
Okay.
That's the misconception is that you can do this in perpetuity. You can't. You can do it for a couple of years or so. It's very nice. And then you can decide to reset it. Just realize now all of them as long-term capital gains and then do another 5 years. It's up to you.
Mm.
But it's a way to create tax efficiency along the way.
Yeah.
Direct indexing. A lot
Yeah.
of people don't know it exists.
Who can people just do this on their own? Or do they need to get with a professional advisor?
Yeah, just put in the time and place all the trades. It's an elevated amount of responsibility and it's a lot more research.
Yeah.
It's just really hard to do.
Mm.
But I mean, anyone's allowed to, buy and sell stocks in your portfolio. Just managing and keeping track of 100, 200, 250 positions.
Seems like a lot of work, but
And you
maybe
get,
some people like it.
well, here's the other part too is when you trade, you're not just trading that price, you're trading with a spread.
Huh.
So what you sell is probably less than what will be purchased.
Huh.
So because the market makers have to make some money. So it's easy to screw up.
Yeah.
I'm just I support the DIY in a lot of different ways. This
Yeah.
is not one I would recommend wanting to
Mm.
do yourself unless you have a background in trading
Uh-huh.
and you can manage those things and you have a Bloomberg terminal or something like that.
Okay.
So
Yeah.
anyway, um, and then the other things too is on your on your return, if you have real estate property, this is a big one.
Mm.
Schedule E is very telling.
Mm-hmm.
Okay. Here's what I mean. In the Schedule E, you want to find out really what is your current market value of the home. And then you want to look at how much is going to each different category. How much are you writing off? Because it's real estate's nice because it's very tax efficient for many years. You can depreciate the asset, which is advantageous from a tax standpoint. You can do all sorts of things. But
Mhm.
at some point, a lot of those tax benefits kind of stop. At some point, you get tired of tenants trash toilets. Maybe the neighborhood's turned on you, whatever it is. And you have to look at yourself and say, I either have to sell this and pay a massive tax bill, or I keep it and I'm basically a slave to this property for the rest of my life. Yeah, it might be paying you.
Mhm.
How well is it paying you? That's another question. Most landlords I have spoken with have not been able to properly assess their net operating income. They skew the numbers. They conveniently omit certain factors. Like, oh, how you need to replace the water heater soon?
Yeah.
Yeah, you're leaving that off your expense. Oh, you know how the roof probably ought to get replaced soon? Yeah, you're leaving that off of your calculations, aren't you? Yeah,
Mhm.
yeah, I know, I know. And this is one of the reasons why on retireontime.com we have the real estate exit calculator.
Mm.
Is that if you just go on there, fill it out, you're going to see your actual net operating income. How valuable is your property really?
So it could be a wake-up call.
Do you want $1 million that's paying you 1%? You could do better in a checking account or a high yield savings account. You could triple your income in a high yield savings account, your cash flow. That's how sad some of these properties are
Mm.
because they just haven't either kept up with it or they didn't raise rent or there's new rental laws now or whatever it is.
Mhm.
So you got to be very careful about that. If the property is not doing well, it might be time to give it to another investor who's a long-term investor willing to put in the capital and then depreciate it over, many, many years and put their heart and soul into it and then bring it up and then make an investment.
Mm.
There's a reason why a lot of institutional real estate investors only want a property for like 10 years. They want to get in, they want to enjoy it, and they want to be done with it. And if they get in, they want to know what they're fixing. That like it's this real estate game that exists. So the moral of this story, if I were to say anything, is your tax return is the secret. It is the key to your efficiencies. It tells all. I mean, really, it's incredible. Look through it. If you buy the Retire on Time workbook, go through the tax section with your 1040, which is your tax return summary. If you have real estate, go through that and go on the calculator, but use your tax return to highlight potential problems and inefficiencies, and then ask yourself, okay, now that I've raised my awareness, what do I do to alleviate the burdens?
Mhm.
You can't not pay taxes, but you could pay more or less, and that's going to be up to you. And that's all the time we've got for this question in today's episode. If you enjoyed it, make sure to tell a friend, leave a rating, and subscribe to us wherever you get your podcasts and or on YouTube, where the best experience is YouTube. That said, remember to go to retireontime.com for the calculators, the workbooks, the book, and so much more. Also, attend a workshop with me live where I actually build a retirement plan and take your questions along the way. If you want help with your retirement plan, you can always go to retireontime.com and click the button that says talk to a planner, where you can talk to me or one of my staff and we can help you prepare for your retirement. Put your plan together, whether it's one time or something else. Thank you for spending your time, your most precious asset with us today. We'll see you in the next episode.